Hey traders, welcome to our Sunday show, Raghee Report. Great to see everyone. All right, so a couple things to kick off this particular session with, and that is starting with our economic calendar. Let's give this thing a glance here. For as busy as last week was, and last week was a significant week, lots for the equity markets, treasuries, currencies to process. This week, on the flip side, is actually pretty quiet. When we have this kind of so we had options expiration Friday. Now we're going into the end of the month, the end of the quarter, the end of the year. And this is where in this window, we're going to start to see a little bit more intensity in the mindset of tax loss harvesting. So think about those symbols that have been weak, most especially over the last month, but for the last quarter. Recency bias does apply. On the flip side of that, also think about which symbols have been very strong. What has been very strong for the last month? What has been very strong for the last quarter? Think about that as window dressing. Think about that as a big part of the mindset behind a little bit of the Santa rally. And in this week, in the countdowntrader.com uh, update, we're going to dive into those three terms, a little bit of techno babble, a little lingo breakdown. What are those three things? Tax loss harvesting, window dressing, Santa rally. Are they real? Is this tendency a trade? Is there something that's syncing up with it? What do we need to be aware of? We're going to be talking about that this week in the countdowntrader.com update. And as we go through the remainder of this week, normal things, unemployment claims, we do have GDP on Thursday. Now, I am not, and this isn't just about this year or going into next year, but in general, I've never been the kind of trader that changes what they do and how they do it, whether that be short term, long term, or my portfolio, based on any recession talk. If there is a quote unquote recession, it's going to take 2 quarters, at least, if that's the way we're actually going to measure it, of negative GDP to say, hey, we're in a recession. So, mind you, it takes 6 months. By the time we get to the ninth month, so in one more quarter, we're usually coming out of the recession. I say usually, right? There's usually a higher probability that we're coming out of the recession, but remember, it's going to take 3 months to get that information again. And therefore, by the time we know what it is, we already can feel the recession before we get this economist definition or this sort of widespread acceptance of this is what we're in. We know that we're in it. We know the water is hot before someone brings a thermometer, right? I don't need the thermometer. I know the water is hot. So that's why I don't make it ever a catalyst for changing what I'm going to do. Because if there is a reaction to it, we're going to see it play out in price. We're going to see it play out in the trends that we're seeing. So I don't make any recession-based adjustment to my trading, which is why I don't really care from a trading and investing standpoint whether or not somewhere some economist is saying we're in a recession. So keep that in mind so you don't get sucked into the narrative. But of course, that's going to bring that narrative up even more on Thursday. So keep those shenanigans in mind. Come Friday, this is far more important than GDP, far more important than any recession talk, is that core PCE number. The PCE is the Federal Reserve's favorite inflation gauge. Inflation is still very much a part of the conversation. Inflation is going to have far more of a significant impact in what it is that the Federal Reserve will be doing in terms of rates, decisions on rates going into next year. Where are we going to end up? Can the Federal Reserve say inflation is cooling and therefore they can be less hawkish? Less hawkish right now is 4.75% to 5%. More hawkish is kind of 5 to 5.25. We can measure that right here with the target rate probabilities. I would keep an eye on March and I would keep an eye on May. And then what gets interesting is how long are we going to hold that peak, that terminal rate? And that's the second part of this, because as soon as we know what our terminal rate is, our peak rate, Then the conversation is how soon will the Federal Reserve start to cut? I know it sounds bonkers sometimes, and as long as we realize we can measure all this, we don't get caught up in the drama of it all. All right, gang, let's jump on over to the charts and jump also into the questions. So kicking it off here, gang. First question. Hey there, Furman. During day trading, do I take into account the V score only during double green or double red structure? No, not at all. I take the V score into account regardless of the structure, because remember, V score is less about price, right? And it's much more about volume. And volume is pertinent in any market behavior, in any market trend, whether that be chop, whether that be an up or down trend. So I will always take it into consideration. It's not something that I feel that, unlike, so in my opinion, volume is not as susceptible to whether or not we're in a trend, say the way that a moving average or a slow stochastic, the way a price based tool would be. Volume in the context of a trend, volume in the context of chop, it's a very different tool. It's much more applicable to really every market behavior that we see. Again, price-based tools really have to be synced up to the underlying market behavior. So thank you, great question. And they are valid in any market behavior, any market trend. All right, next up, I am Groot. Visa, you want to go long on the daily, okay? But should we be concerned that XLK will drag it down? I think that there's a couple ways we can go about this, and I'm going to jump into the tops layout to have this conversation. So let's do this. Let's jump into tops, and then we're going to take a look at, we're going to discuss what it is that we're dealing with XLK. So for those of you that have never dove into the XLK and looked at what is within that ETF, when you look at the holdings, I'm going to give you them in order: Microsoft, Apple, Nvidia. Number 4 at also 4% is Visa. And when I look at XLK, you can see that we haven't really held a trend in XLK since August. Keep that in mind. Visa, is it a relative outperformer compared to the XLK? Absolutely. Big time. And Gert, we're sitting on the 200. That's a level that's not only useful for our entry potentially, but it's also going to allow us to perhaps use it and perhaps even a volume ledge at around 204 to help us keep perhaps a tighter stop than I normally would had I not had those two levels helping us out. So those are two things that are really worth keeping an eye on for a long Visa. I'm good with that. And then, of course, you mentioned that Visa is also in the Dow. Again, if you look at the Dow, and I think it's worth looking at the Dow, but I'm going to look at the futures contract. If I look at the futures contract in the Dow, Visa is about 4% of the Dow as well, but it's much further down the list in terms of weighting. However, I am still a Dow bull. If there's any index of the Russell, Nasdaq, S&P Dow, that group of 4, that I would be bullish in, it is this one. And then within this, we have things like XLI and XLV. But Visa itself, it's a high concentration weighted, let's see, 1, 2, 3, 4, 5, 6, 7, 8, ninth heaviest weighted stock in the Dow. It is worth keeping an eye on. And again, relative outperformer in XLK, beautiful 200 propulsion support. All right, next question is RTX. I went long Friday. Okay, at 97, bought one call. What should T1 be? I think when we look at a T1, and I love that you're asking about a level that is in front of a brand new high. And it reminds me of something that I tweeted just last week. And where is it? Here we go. Manage risk like the trade is going to lose. Set targets like the trade won't make a new high. Position size to be able to trade again tomorrow. And with that in mind, yeah, I love that you're not asking about a level higher than 102. Fantastic. We have a volume ledge at 101.7 or 100.70. We have candle bodies around 101.50. And the major psychological level really doesn't have a lot of volume associated with it, actually. No, not at all. So I'm not as concerned, but if you are concerned about 100 on the way to perhaps a T1 at 101.50, 101.45, that's what I would say would be a good level to keep an eye on. As we get to, say, 99.90, 99.95, you can move to a break even stop. Even if you don't want to scale out, you can move to a break even stop. And we do that quite a bit, most especially when we're day trading in the Sector Secrets Mastery Room. We'll say, look, we don't necessarily want to scale out yet, but um, there is some thought that if the market turns back around, let's only risk unrealized profit. And by moving to that break even, right? By moving to that break even, we can reduce risk while we're still waiting for that T1 to be hit. So I like doing that a lot. Group. All right, next up, if the ZB and indices are out of sync, will I choose not to trade at all, or will I prioritize one over the other? Prince, check out the video, and that's for day trading, right? Prince, check out the video that I posted on right here 5 days ago. How to pivot on a volatile morning. How to pivot on a volatile morning. This particular update right here. And that's exactly what that entire video was dedicated to. What I will pivot to, and will I favor trading the indices or will I favor trading the treasuries? And I will favor treasuries. If treasuries and indices zig while the other is zagging, that is not what I want. When I see treasuries moving higher, I want to see also the indices moving higher, or at least generally moving together. And if I don't have that, I will trade treasuries most of the time. But check that video out, and I think that that will help a lot. All right. Next up, so some confusion about the time. No, we've been 6:30 now for a couple of shows now. We're going to hold this 6:30 Eastern time. I was not with you, however, last week because I was at the Austin mentorship that we had, well, in Austin. So I was not with you all last week. But yeah, we're going to stick with the 6:30 timing that we've been using now for a couple of weeks. So thank you for. And now, is there going to be a show next Sunday? I'll tell you what. I mean, 24th is Christmas Eve. No, I'm probably not going to have a show. I'm definitely not going to have a show on Christmas Eve. Now, if it were any other Sunday but Christmas Eve, which kind of is a little day unto itself, I would have thought about it. But no, there will be no. Or is it Christmas? No, that's Christmas, right? Sunday. So no Christmas show. No Sunday. No, so no Sunday show. But what about New Year's Day? The first? Oh yeah, I don't mind New Year's Day. Yeah, New Year's Day. We'll definitely have a show. New Year's Eve would have been. Oh heck, I would have done a show New Year's Eve too. But no, New Year's Day we will definitely have a show. All right, so let's see. Next up is hey there, SK. When I say exhausted, what are the parameters I am considering for day trading, swing trading to close the trade? When do you swing? When you do swing trading, you look at percentage or a projected target price. So exhaustion and resistance, or exhaustion and support. Is the market stopping moving higher or lower? Or another way of thinking of it is, has momentum waned? Are we not seeing as much momentum? That's one way to think about it. But as far as the other part of the question, when I swing trade, do I look for a percentage? Never. No, I do not. I do not look for a percentage. We always have, with our setups that we send out in the futures room, in the simpler futures room, or in my Sector Secrets Mastery, we always have a T1 in the alert. So I already know where I want to get in before I get in, and I already know where I want to get out, that T1. So yes, it's based on price. Yeah, it's based on price, SK. All right, next up. Hey there, David. Netflix has pulled back to the wave. It sure has. Is this a long entry? Oh, is this a good long entry considering the broken? So no, I think we're right there. No, I think we're right there. And so let me show you what I'm looking at. Let me grab my drawing tools. There we go. All right. Well, first of all, there's a volume ledge right here. Awesome. Our 200 is right in that area. So I don't consider that to be dramatically broken. The 200 does tend to have some gravitational pull, both when price is under and just above it. That's fine. And then, as you said, we're in the wave, right? Awesome. We have the right structure, green momentum, green trend. Yes, that's definitely something I would keep an eye on. Would that be considered a buy the dip? Is this a buy the dip? Yes, this is a buy the dip. Buy the dippable. You got it. All right, next up is, and by the way, that volume ledge, David, is sitting at about 291. 291, and that 200 is sitting at about 292 and change. So I like that proximity. It's a nice stacked area. We have size, which means attention. We have the 200, which means attention. Yeah, we like that a lot. All right, next up, Al, thoughts on the ETF dog? Okay. These ETFs, right? So many of them. And also a new one called DIP. Interesting idea, but not much volume. Sometimes the merit, to your point, Al, of an ETF and its existence is really sometimes merely does it tell me a lot about the stocks within that holding? In other words, if there's volume, then those stocks could move together. If there's not a lot of volume in the ETF, chances are the stocks aren't going to move together much. Now, if you look at the holdings of dog, just a bunch of T-bills. Most of your weighting is just a bunch of T-bills. So I could put a position on myself if I want that type of exposure, or if you want exposure to T-bills, then definitely dog would be something to keep an eye on. As far as what was the other one? Dip. I know nothing about dip. I know next to zero about dip. So and I will say, if there's not volume, then I'm going to be very suspect of the influence. Because remember, the reason we look at these sectors via their ETF, and I know you know this, Al, but this is for maybe people new to the way that I look at the market. The reason that we look at volume that's associated with these ETFs is that we know then there's attention, and attention is where people will make trading decisions. And I know that those stocks are more likely going to be influenced by each other, as opposed to a group of stocks where there's no volume really. That is telling us that there's a tension, right? And therefore they're not going to move together. So that volume is huge. That volume is huge. All right. All right. So I hope that helps. Let's see what else we have here. Bear with me. As far as what we have in the bear with me here, gang. And the Dow. So the dip and the dog, right? Dog is it inverse? All right. Isn't it interesting that an inverse ETF to the Dow is just a bunch of T-bills? I'm not a big fan right now of being inverse the Dow. I'd be far more interested in a way to get long this corner of the market, mainly because of one of the topics we kicked off this session with, which is how can I look at the overall strength in the Dow compared to the other indices, and then pluck out, we talked about Visa earlier, right? How can I pluck out those corners? XLI might be a good place to keep looking. Healthcare most definitely is, relatively speaking, to even the Dow itself. And there's a number of stocks within the XLV that are worth watching too. If the Santa rally, let's take Santa rally out of it. If our window dressing rally, which make window dressing makes sense when you think about what it's trying to accomplish. I'm not saying it's a good thing, and most people deny it even happens, but come on. So if you're a portfolio manager, if you're a money manager, we've seen a surge into the last part of the year, again, going back 1 to 3 months. Two things. One, do I not want to show that I'm participating in it in some way? If I'm having to at the end of the year present, hey, this is what you have going into 2023. And let's face it, a lot of people who are letting their money be managed by other people, when they open up their statements, they want to know, hey, I've got exposure to the strength in the market. Not all traders and investors are taking the time to educate themselves like you all are, right? A lot of them don't think about, it doesn't matter that I own, for example, the XLV. What matters is the cost basis. Where do I own it from? How much? What's my average cost? Now, frankly, probably the interesting way to go about positioning for next year might be, where can I take advantage of a very low cost Amazon? Where can I take advantage of the XLC or Disney or some of these stocks that are really taking on water right now? However, most traders and investors, most, not all, most are not of the buy low, sell high variety. They're really not. They're buy high, sell higher, right? And if a market sells off, they're usually liquidating holdings rather than thinking about, gosh, do I really believe that Amazon moving lower is not an opportunity that I'm going to kick myself for not taking advantage of? I mean, Amazon is $87. It's $87. Come on, really? So those are things where I might jump on over to a weekly, and I'll wait for Amazon to come out of the downtrend that it's in right now. But most definitely, I want to think about, at what level could I start thinking about Amazon? I'd like to see it above the 200 exponential. We're not there right now. You can see the unsuccessful attempts at breaking that. So please remember, that's still very much an obstacle to the upside. But once we start to get a bottoming pattern, maybe it's a 1, 2, 3 in a neutral environment on the daily or the weekly. Look, these are the kinds of moves that don't happen a lot. But I know personally from experience, I will kick myself if I don't think about the fact that there is a wonderful opportunity here. So that's the way I look at that there. All right. Okay. So did I have a typo in the description? Well, I know I didn't have a typo in the time. So again, 6:30 Eastern. Write it down. That's going to be our new time. It's been our new time for a few weeks now. That's the time we're going to keep doing the show at. Okay. All right. Cool. All right. Next up, hey Timothy, I appreciate that. I appreciate you all coming out, taking time out of your day, maybe missing some football. I don't know how the Bucks are doing against the Bengals. That's actually turned out to be a pretty good little game. Yeah. So thanks for taking time out in your day. Absolutely. All right. Next up is break even stop versus trailing stop. How do I decide which one to use? It depends on where we are within the life of the trade, within the journey of the trade, Mr. Walker. So a break even stop is the most important adjustment that we can make as a trader. A break even stop is, how many of you have heard, don't let a winner turn into a loser, right? Say aye. All of us have, right? Don't let a winner turn into a loser. What does that even mean? Don't let a winner turn into a loser. What does that mean? Well, how do we say a trade's a winner? For me, it's when it hits the first target. So first we define what a winner is. It isn't just a trade that now is on the positive side of P&L. It's a trade that actually has reached the target we determined and put in our trading plan. So that's a winner. T1 is a winner, target one. All right. Don't let a winner turn into a loser. Well, what's a loser? How do I define a loser? A loser is giving back my money. I don't mind to give back the house money. I don't mind to give back unrealized profit. But a loser, my definition of a loser is when I'm losing my capital, not unrealized capital, not unrealized profit, not even profit. When I'm losing my money. So now that I know what a winner is, and now that I know what a loser is, how do I go about not letting a winner turn into a loser? Which is good advice. When we hit the first target, we move to a break even. That's the first adjustment and the most important adjustment that I ever make in a trade. Now, going to trailing is, more involved with second targets and things like that, or my trust or mistrust the market. But the most important adjustment, Mr. Walker, to your question, I thank you for it, is when and why do we go to a break even? And if you notice, it has a lot to do with the first target. A lot of traders, when they're thinking about um, risk management, don't think about enough the importance of the first target being part of risk management. Part of risk management to me is reducing the exposure, the size of the trade. That's part of risk management, right? And then in this case, if we can realize a profit while doing it, even better. So that first target is very much part of risk management to me. All right. So terrific question. Next up, 3,700 coming or breaking back above. Um, the question here, Jay. You asking which way we're going? I have no idea. I never base any of my trading and on where the market is going to go. I mean, we're closer to 3,700. Um, Are we 30? Where we are right now? 38. We're at basically 38. Oh no, we're closer to 39. Well, either way, I have no idea. I have no idea, Jay. Um, I never want to have to go into prediction mode. And frankly, even if I put that number out there, that's a target. And that's only one of three things that make up a trade. I mean, there's three things that make up a trade: entry, stop, and target. So if I say, yes, we're going to 3,700, what does that mean? It actually means nothing. For a lot of traders, unfortunately, though, especially in social media and actually traditional media who talk about targets as if it validates or justifies an entry, now we're traders. We know that an entry needs a number of criteria to be met. And then we start thinking about a stop loss. And then we start thinking about a target. So I really don't know, my friend. Let's see, Argentina. Yeah, it was so great. It was very cool to see Messi get his World Cup. I mean, now he could, that's one of the things Maradona had, who I still think is the greatest soccer player ever. And yeah, now he's got that World Cup amongst, look, he and Ronaldo could open a museum with all the trophies that the two of them have, from being as accomplished soccer players as they are. So, yeah, it was great to see him get that World Cup win and retire, right? Fantastic. No, that's a great end to a very storied career. Yeah. All right. Next up. So is Amazon in short the rip mode? Yes. Yes. Amazon is in short the rip mode. It is. Absolutely. Absolutely. And with that in mind, if we get an opportunity between now and the end of the year, look, this is the kind of stock. We have a downtrend. Whatever the trends are, I have found generally, this is not the time to look for V bottoms and U bottoms and reversals as we wind down the year. This is the time to see trends continue, if not accelerate, in the direction that they're in. So I would, again, every year has its own catalyst, and every year is going to have different reasons for traders to be bullish or bearish. But generally speaking, I would look for more strength in healthcare. I would look for more strength in the Dow. I would look for more weakness in names like Amazon and even Tesla. And then that's going to that's going to pull on the XLY pretty hard because those two stocks are so heavily weighted within this corner of the market. And frankly, within the NASDAQ, right? That's one of the reasons the S&P is not moving with the Dow, which sometimes it does, because the fact that it shares the financials, XLF, and healthcare XLV, they have those shared components. One of the reasons the S&P is not moving with the Dow is because of tech, is because of that XLK, is because of the weight of the NASDAQ. But yes, Amazon is in absolutely short the rip mode, at least for the remainder of this year. Now, early next year, I'd keep an eye on it, on Tesla, on stocks within the XLC. If we're going to see some bottom picking, if we're going to start to see rotation out of the very strong names of the past 2, 3 months, look for that to come, that kind of rotation from a lot of strength to possibly some weakness early next year. Because if we're thinking about upside, if we're thinking about the best kind of upside, is it buying high and hoping for higher? Or at some point early next year, is it, okay, where can we take profits in the Dow or healthcare or what have you and start to go bargain hunting as we begin a new year? And that's what I'll be looking for as we get to, say, mid January to mid February. So, yeah, absolutely. All right, next up, Captain Jane asks for my annual anchored VWAP. Sure. Do I wait a month or two to reset? I'll wait at least a couple of weeks. Yeah, I'll wait, Captain Jane. I'll wait at least a couple of weeks. Yeah, absolutely. Yeah, great question. I will wait. And that's also going to apply to um, the VWAPs and the V scores, the V score bands, right? All those are going to be, we anchor those. And yes, I will wait to re-anchor those yearly, those annual, as you said. Great question. I will absolutely. All right, gang. As always, thank you for joining me for our Raghee report on Sundays. Again, going forward, we won't have one next Sunday, obviously. I will not see you all. But again, Merry Christmas to everyone. I won't see you. I'll see you during Charts and Coffee, but we will not have a next Sunday. I will do the first, though. I don't have a problem having a Raghee report New Year's Day. I think that would be awesome. All right. So, gang, thank you as always. On the 1st of January, 2023, I will see you all 6:30 p.m. Eastern for the first Raghee report of the year. Thank you so much, gang, for being with me and your fellow traders here in the room, asking questions, getting ready for the week. I really appreciate it. I appreciate the time. I appreciate the questions. And I'll see you all tomorrow morning, 9 a.m. Eastern for Charts and Coffee. All right. Be good to each other.